gas prices have actually fallen about $1.40 from their peak. Some are worried, though, that they could go back up in the winter. Should Americans be ready for that?
Well, it's a risk, and it's a risk that we're working on the price cap to try to address. This winter, the European Union will cease, for the most part, buying Russian oil. And in addition, they will ban the provision of services that enable Russia to ship oil by tanker. And it is possible that that could cause a spike in oil prices.
U.S. Treasury Secretary Janet Yellen appeared on CNN's State of the Union on Sunday, where she discussed the U.S. economy, inflation, gas prices, and Russian oil. One notable part of the Treasury Secretary's interview is that she warned there could be another spike in oil prices during the winter. In June, the European Union imposed a ban on seaborne imports of Russian crude oil from December 5 and petroleum products imports from February 5, 2023. The ban also stops EU companies from providing shipping insurance, brokering services, or financing for oil exports from Russia to other countries. According to Yellen, Americans could experience another massive spike in oil prices when the sanctions come into effect in the winter. Gas prices hit a record high in June when inflation peaked at 9.1%. Since then, prices have fallen steadily. But the decline in prices might be only temporary. According to the Treasury Department, the ban on insurance for Russian seaborne supplies could take up to 5 million barrels per day of crude and refined products off the market, triggering another massive price hike. In addition to Janet Yellen's warnings, the Bureau of Labor Statistics released its monthly report on the Consumer Price Index on Tuesday, and the figures came as a shock to the markets. According to the reports, U.S. CPI inflation jumped by 8.3% in August compared to the same period in 2021. The reduction was less than expected, and market analysts believe the report will trigger more aggressive rate hikes from the Federal Reserve. The hotter-than-expected inflation figures immediately triggered a market sell-off. On Tuesday, the U.S. stock market experienced its biggest fall since June. Dow Jones fell by 1,276 points, or almost 4%. Nasdaq tanked by 5.1%, or 632 points, and the S&P 500 lost 177 points, or 4.3% in the closing trade. There were noticeable signs of volatility in the crypto markets, too. Bitcoin plunged from $22,600 to $21,115 within a few hours of the announcement. As of press time, the flagship cryptocurrency is now trading at $20,364, having lost more than 9% of its price in the past 24 hours. Ether, the second-largest cryptocurrency, also took a plunge from $1,739 to $1,567 after the announcement. But the crypto asset has recovered slightly and is now trading at $1,600, largely due to the upcoming merge, which is just a few hours away. Welcome to Savvy Finance. Before we bring you the rest of the video, please take a little time to hit the like button and drop your comments and observations in the comments section below. If you would like to stay updated on market trends, then ensure you subscribe and turn on post notifications for more videos like this. Thanks and enjoy the video. There are at least two pressing issues which could negatively impact the U.S. economy in the coming months. The first is the price cap on Russian oil, which analysts say could work in the long term, but might increase oil prices in the coming months. Officials in G7 countries, including Yellen, explained that the unprecedented measure will help reduce the price Russia receives for its oil without worsening the global energy prices. Here is Janet Yellen speaking about the price cap and how it could affect Americans.
You talked about gas prices coming down, and last week you praised an agreement among G7 countries to finalize a price cap on Russian oil. Gas prices have actually fallen about $1.40 from their peak. Some are worried, though, that they could go back up in the winter. Should Americans be ready for that?
Well, it's a risk, and it's a risk that we're working on the price cap to try to address. Our price cap proposal is designed to both lower Russian revenues that they use to support their economy and fight this illegal war, while also maintaining Russian oil supplies that will help to hold down global oil prices. So I believe this is something that can be essential, and it's something that we're trying to put in place to avoid a future spike in oil prices.
In her interview, the Treasury Secretary also expresses concerns that the economy could slip into a recession as the Federal Reserve has to keep tightening to bring the economy back into an acceptable place.
Well, of course, it's a concern. The Fed is going to need great skill and also some good luck to achieve what we sometimes call a soft landing, which is bringing inflation down while maintaining the strength of the labor market. And my hope, I believe there is a path to accomplishing that, and my hope is that we will achieve a soft landing, but Americans know that it's essential to bring inflation down, and over the longer run, we can't have a strong labor market without inflation under control.
You said that there is not a recession currently. Are you worried that a recession could come? Is it still a threat?
Well, it is a risk when the Fed is tightening monetary policy to address inflation. So it's certainly a risk that we're monitoring. And we're seeing some slowdown in growth, but that's natural.
Another economic concern that has gripped investors since the release of August's CPI figures is the notion that inflation has gotten entrenched into the economy. Investors and other market participants are rightfully concerned that an ultra-hawkish Fed might trigger a hard landing for the economy. According to the Bureau of Labor Statistics, the Consumer Price Index for all urban consumers rose 0.1% in August. In July, the metric remained unchanged. Over the past year, the headline inflation index also increased by 8.3%, down from 8.5% in July, but much higher than analysts had predicted. Market strategists had estimated there would be a 0.1% decline in prices month over month, and that the annual inflation would slow to 8%. On Tuesday, popular gold advocate Peter Schiff declared on Twitter that inflation is here to stay. His tweet reads, "Once again, the market's reaction to a much higher than expected inflation is wrong. Inflation is here to stay and will get much worse despite rate hikes due to over a decade of inflationary monetary and fiscal policy. This is very bearish for the dollar and bullish for gold." In addition to the stock and crypto markets crash, the inflation figures also impacted commodities prices. Gold, silver, palladium, platinum, and rhodium all saw losses against the U.S. dollar after the Bureau of Labor Statistics released August inflation figures. In an earlier tweet he put out on Monday, Schiff also noted that the Fed Reserve might not be able to achieve its 2% inflation target. His tweet reads, "The days of sub-2% inflation are gone. There's no going back to the anomaly experienced between the 2008 financial crisis and 2021. The inflation chickens the Fed released with QE have finally come home to roost. The price increases experienced thus far are just the beginning." What do you think about Janet Yellen and Peter Schiff's statements on the future of the U.S. economy? Please drop your comments and observations in the comments section below. Also, ensure you hit the like button and subscribe to the channel. Everything you do helps with the YouTube algorithm, so we can continue to bring you these videos. Thanks for watching.